Hello everyone, welcome to my channel Sujit Patra Ekdam Real Estates. So hope you all are in good health and good spirit. In my previous video, we have discussed about capital gains. So what are the capital gains? What is capital assets? So now this is part 2 of my earlier video. What is the exemptions under capital gains? What are the exemptions under capital gains? What are the sections under Income Tax Act which are applicable for claiming on the capital gains? So this capital gains arises because only due to when you are selling a capital assets or land or property, that is the capital gains arises. And when any capital gains arises, so obviously it will attract a income tax. So this income tax, when it is applied, it requires a lot of prudence and knowledge about the what are the provisions under Income Tax Act, how to claim exemptions. So if you do not have the idea, then it is very difficult to get those exemptions, because these exemptions affect the financial plannings and the investment also. So before going for any selling of any capital assets or land and building, or before going for this purchase of any land and building, so you must know this capital gains exemptions. What are the exemptions applicable or allowed under Income Tax Act? So there are different sections under Income Tax Act, but it falls under section 54 only, and there are many subsections under 54. So the basic, that is section 54, it applies to the sale of residential property, and that is when you are selling any residential property, what are the capital exemptions are there and its applicability. Basically it will be applied, or it will be applicable if you have purchased 1 year before or 2 years after the sale of any property. But and when if you are constructing any property, then it must be constructed within 3 years from the sale of the property. But there is another provision is also there. If it is not fully invested in that particular financial year, then you can open a capital gains account scheme under a bank, and it can be spread over. So this capital gains account scheme you can spread over by opening one account in a bank, and while depositing the capital gains in that particular account, then you get a receipt. This receipt, on the basis of that receipt, you can gain capital gains exemptions while filing income tax returns. But the amount which can be deducted is limited to the cost of the new property or the capital gains amount, whichever is lowest. Then the other section is that for agricultural land. For agricultural land, the section is 54B, and if you are reinvesting the capital gains arising from agricultural land, you have to reinvest in purchasing another new agricultural land only. But this purchase must be within 2 years from the sale of land, and subsequently this agricultural land has to be used for agriculture use for minimum 2 years. And here also the capital gains amount or the amount invested in the agricultural land, whichever is lower, that amount is the deductible amount under capital gains exemptions. Then similarly under section 54D, that is for any industrial undertaking. So any acquisitions of any industrial undertaking, it has to be used for industrial undertaking only, but this purchase must be within 3 years from the date of receipt of the compensation, and this land and building acquired must be used for industrial undertaking prior to the sale minimum for a period of 2 years. Here also either the investment in the industrial undertaking or the capital gains, whichever is lower, that is only applicable. Then section 54 EC. So that is sale of land or building or both by any individuals. Here actually you can invest through any bond. So generally these bonds are issued by NHAI, the National Highway Authority of India, or the Rural Electrification Corporation, that is REC. But you have to invest within a period of 6 months from the date of sale, and the investment amount maximum can be 50 lakhs only. It cannot be more than 50 lakhs. And here the deductible amount will be either the investment amount or the capital gains, whichever is lower. And under again section 54E, 54EA and 54EB, sale of any long-term capital assets by any taxpayer. Here you can invest in specified securities like government securities, savings certificate, units of UTI, or any specified debentures, but it has to be invest within 6 months from the sale of the asset. And here also the deductible amount will be the investment amount in the purchase of asset or the net consideration amount. Then sale of any long-term capital assets by any taxpayer, that is section 54EE. Section 54 is when you are investing in any units of a notified fund to finance startup. It is to finance startup, then this section 54E is applicable. But here the maximum investment can be not more than 50 lakhs and the investment has to be within 6 months from the date of your sale. That is under section 54EE. But here also the investment will be, the deductible amount will be limited to the invested amount or the capital gains, whichever is lower. Okay. The other section is section 54F, that is applicable for long-term capital assets other than house property. So it is very important. So when you are purchasing any house property, it is for any property other than house property, but the house or other properties has to be purchased 1 year before or 2 years after the sale of any property. And if it is construction, then the construction has to be completed within 3 years from the sale of any particular property. Here the deductible amount will be the cost of new asset or the capital gains, whichever is lower. And if the long-term capital asset is industrial undertaking, and if the industrial undertaking is plant and machinery or the land and building, and it is for shifting from urban areas to rural area, then the section 54G is applicable. But here you have to purchase within 1 year before or 3 years after the sale of the asset, and the asset sold can be long-term capital asset or short-term capital asset. But here actually the catch is that investment has to be minimum. It will be restricted to either the capital gains amount or the lower of cost of new assets. The other section is section 54GA if the industrial undertakings from urban areas to SEZ, that is special economic zone. So if you have sold any plant and machinery, land and building or any industrial undertakings, it has to be use for purchase of same industrial undertaking or for land and building or for plant and machinery, but it has to be purchased within 1 year before or 3 years after the sale of the assets. And it can be used for long-term capital assets as well as the short-term capital asset, and the deductible amount will be restricted to the capital gains amount or the lower cost of the new assets. Then another section is section 54GB, that is sale of residential house property or residential plot of land by an individual. Here it can be reinvested in the subscription in the form of equity shares of eligible company or startup. So that eligible company or startup should utilize the amount of subscription for purchase of new assets. That means the startup should use this investment for purchasing of their new assets, and the deductible amount will be the cost of new assets or the capital gain, whichever is lower. So it is a very important things. You should know what are the exemptions under this capital gains under different sections, because it affects our financial plannings and investment. So it requires lot of prudence. So this you should know, otherwise our tax liability will be more. So there are provisions under Income Tax Acts. So hope you have liked my earlier video on for capital gains and this part 2, that is capital gains exemptions. So hope you must have enjoyed my video. Please like, share and subscribe my video also. Thank you.